Hello, everybody. Nice to be here today. My name is Mrin Agarwal. I'm a financial educator working towards helping people achieve their financial freedom. I'm sure over the last couple of months, you've been pretty concerned about your money. By way of background, I have been an investment advisor for more than 23 years, managing some very high net worth money, and I've been a financial educator for the last 6 years. And I see that people all around are very, very concerned about their money. And why not? With the markets being down 26%, 5 year SIPs being negative, banks failing, interest rates falling, it's a very, very difficult time for most investors because they really don't know where to park their money. Real estate is also stagnant. Gold, while the prices are just going up because of all the loss aversion that is there. And due to that, it has become very difficult to really decide where you invest your money so that you can get an inflation adjusted return. A lot of people are also facing financial difficulties due to which they basically are not sure whether to continue on with their existing investments. There are also those who do not, are worried about the negative returns on their investments and hence want to basically, maybe exit their investments. So, point number one, if you have invested in the equity markets, let's say 2 years back or 3 years back, and you are seeing negative returns at this point in time, here's what I would suggest. First and foremost, you need to relook at why did you invest this money in the first place? Was there a goal attached to it? Now, typically, I see people invest in a very ad hoc way. So, if mid cap funds are doing well, most people tend to just go and invest in mid cap funds. If large cap funds are doing well, people go and invest into large cap funds. But whenever you invest, you need to invest for a financial goal. So, even if you had invested without a goal in mind, and you see the return is negative, the first thing that you need to do is see, can I tag this investment to a particular goal? If yes, let's say you say, okay, this investment that I have made is towards my retirement, which could be more than 20, 25 years away. In that case, you can certainly hold on to this investment because remember, markets in 2 to 3 years can be very, very volatile. And generally, I have seen this tendency where people tend to exit in underperforming investments and they feel, okay, I'll exit right now and then the markets are going to fall and I'll enter in right at the bottom. Let me tell you, nobody can time the markets. And actually, the cost of timing markets is very high. So, typically, in equity markets, 80% of returns are actually made 20% of the time, but you need to be invested for that 20% period. And if you actually miss out those key periods of being invested, then you actually lose out on a very large portion of your returns. So it's very, very difficult to catch the bottom. And hence, I would suggest that if you do not need the money right now, and if you can tag your investment to a goal, and this goal is more than 7 to 10 years away, then you can certainly hold on to your investment. Now, for those who are in need of money right now, you really need to evaluate, do you have any other ways of basically accessing cash? And if not, then unfortunately, you really don't have an option but to basically exit these funds. Um, you know, During COVID and also generally also, given the fact that jobs are no longer secure and given the fact that there's so much of uncertainty, I mean, 3 months back or even in February, nobody thought that there would be a lockdown and we would be working from home. And I'm sure most of you were actually looking at thinking as to where you're going to go for summer vacation. Well, that seems like a dream now, doesn't it? So, at all points in time, I think it's become more and more important for you to focus on financial security because at the end of the day, at a bad time, it is only your money that can really help you get through. So there are two things that you need to do in when you focus on your financial security. The first thing is to get your basics right, and the second thing is really to focus on your goals. Now, getting your basics right means that you need to be having an emergency fund in place. So, in case of a loss of income due to whatever reason, you have this fund to basically fall back on. This is typically 3 to 6 months of your expenses kept aside into an instrument that can be easily accessed by both you and your spouse. Why your spouse? Because in case of a medical emergency, the spouse needs to have knowledge and access of this investment, right? So that's point number one. Secondly, you also need to have the correct amount of life insurance. I find that in India, people are very, very underinsured. And so at least you need to have 10 times of your annual gross salary as a cover. If you have a larger number of dependents, then you really need to look at what sort of covers you need to take. I'm sure you're all aware there's a human life value calculator that you can access on any insurance company website for you to figure out how much insurance you need to have. Now, the third thing that you need to have as a part of contingency planning is the right amount of medical insurance. While a lot of you would be covered from the employer cover, it is important for you to have an external cover as well, because in case of a job loss, you don't want to be in a situation where you are not covered at all, right? So it's important for you to assess your needs. Again, if you have if your parents are dependent on you, and if you need to have parents cover, please have that separate from your cover. Do not mix the two covers, because the parents cover is going to be much more expensive and there might be some loading out there. So have two separate covers. Always have some amount of external cover so that in case of job loss, your cover still continues. So these are the three basic things as far as contingency planning is concerned, which is one, have your emergency cash in place, have the right amount of life insurance, and have the right amount of medical insurance. Now, many a time people feel that it may not be a good idea to spend on medical insurance if you're already covered by the company. And many times people think of this as an unnecessary expense. What you need to remember is that insurance is something that you take to protect yourself against uncertainty. And given the fact that you don't know when this uncertainty can come, it is always better that you take this insurance to protect yourself and look at it as a necessary expense, not as a non essential expense. Apart from this, in your financial life, you need to focus on what you can control. You cannot control what's happening in the market. You cannot control the geopolitical situation. You cannot control a whole lot of other factors, like how much the FIIs are going to invest or how much domestic institutions are going to invest. None of these are under your control. But what you can control is your own goal planning, where you invest, how you invest is something that you can control on your own. Other than that, another very important thing that you can control are your emotions. Many a time, I find that at times like this, people get very perturbed by all the volatility. And then you've got so many people talking so many things. Like right now, everybody seems to have become a market predictor. Everybody seems to have become an epidemiologist. Everybody seems to be predicting everything. And this is very common. So I think you just need to keep all that noise out, really focus on your own financial life. What are your financial goals? Are you investing as per your financial goals? Also, it is important to take some amount of risk. Again, I find a lot of people who still want to invest only in traditional fixed investments. But remember that these investments, while they give you a fixed return, they do not really beat inflation. And at the end of the day, you want to have instruments that beat inflation. There are very few of them today which do it. So your PPF does it, the Employee Provident Fund does it, and of course, if you invest into debt or equity mutual funds. But it is important to take some amount of risk in your investments, because only when you take some risk are you going to be able to have a good growth in the portfolio. Remember, the inflation on a lot of things that we are saving for is very high. I'm sure you'll agree with me when I tell you that the education inflation is at least 10% per annum. Think about the increase in the school fees. So, if school fees is going up by 10%, then imagine higher education fees, how much that is going up by. So hence, it is important for you to focus on instruments which help you beat inflation, for which you will have to take some risk. I do find the National Pension Scheme or the NPS a very good investment for retirement. So those of you who've not opened the NPS account, I would really recommend that you look at the NPS account, because it's a very low cost investment and it allows you to invest in a way that you could compound your returns over the long term. Now, there have been various COVID measures that have been announced by the government. Um, One, of course, being the EPF advance. I don't recommend it. You've been allowed to withdraw 75% of your EPF balance or 3 months of your basic, whichever is lower. I don't recommend withdrawing it because you're really going to lose out on the compounding effect. So, for example, if an individual is withdrawing 75,000 rupees and the person has 33 years left to go for retirement, can you imagine the amount the person is going to lose out? The person is actually going to lose almost 12 lakhs rupees as compounded interest over a period of 33 years. That's a lot of money to lose out on. So I wouldn't recommend withdrawing from the EPF. Similarly, the government has allowed you to take a moratorium on your credit card outstanding. A moratorium only means that you're allowed to defer your payment. It's not a holiday, which means that it does not mean that you don't have to do the payment. You do have to do it, but after 3 months. But remember, if you take the credit card moratorium, then the interest certainly is going to get added. And the big googly is that if you make any purchases in the interim, which is in the next couple of months, they would be interest charged on that as well. So that's not an option for you. On the EMI moratorium on the home loan, again, the issue is that if you do not pay the EMI for 3 months, the interest amount for the 3 months gets added to the outstanding loan amount on June 1st. And what this means is that you're going to pay extra interest and your loan tenure is going to get extended. So, to give you an example, on a 30 lakh loan that is outstanding for 15 years, if you're going to take the 3 month moratorium, your EMI is going to get extended, I think, by 8 months, and the extra interest is going to be 2.35 lakhs. That's a large amount of interest to be paying just to take a 3 month deferment. Now, I also see that many companies and many banks are coming out with COVID related personal loans. I mean, given that all of these, like the EMI moratorium or the credit card outstanding moratorium or the EPF advance, is not an option, some banks have come out with the COVID personal loan, which is at a much lower rate than the regular personal loans. I'm also seeing that you're allowed to pay your rent by credit card and stuff like that right now, honestly, I don't think that you should do all of this, because I just recently saw a big discussion on paying rent through credit cards, so that you can get that extra 45-day period on that amount and you can utilize that amount. I think if you are in that situation where you have to plan all of this, like you have to pay rent on credit card, if you are in that situation, then you really need to focus on your expenses. And I don't think that it's a good idea at a time like this to actually pile on more loans, because you really don't know what's going to happen in the future. You really don't know, with respect to the recession or with respect to job security. And hence, I would really not suggest piling on more loans at this point in time. So, what are the next steps? Well, the next steps, as you all know, from April 1, you need to choose between the old and the new tax regime. Now, there is a calculator on the government, on the IT department's website, which tells you based on your income where you're going to pay more tax. But just a word of caution on the new regime, while it allows you to have more cash at hand, you need to still keep investing for your financial goals, and you still need to worry about the long term financial security. So, I would not really recommend the new tax regime. It works for people below a particular income level. But if your deductions are going to be more than 2.5 lakh rupees per year, then certainly the old regime is going to work out better. So the first step, of course, is for you to decide which tax regime to go with. I would recommend the old regime. In terms of what are the other next steps, well, I would suggest first and foremost, please have a check on your expenses. You could use like a budgeting tool or an expense calculator, or you could just use simple Excel where you put down all the expenses that you've had, mark out the essential and the non essential expenses, and see where it is that you can actually cut down your expenses. I do believe that, till the time this uncertainty lasts, it's important for you to be saving to your fullest. And of course, right now our lifestyle expenses are quite low because we're not going out, we're not having fun anywhere. So certainly we are going to be saving that money probably for the next 1 or 2 months. But I always believe and I always propagate the 30-30-40 budgeting rule, which is 30% expenses, 30% EMIs, and 40% savings. Yes, you heard it right. It's 40% savings. So see if you're there, see where you are with respect to this number. If you're like 5% off, it's okay. But if you're in a situation where you're only saving 10% of your take home, then that's something that you need to rectify. And there's only one way to rectify it, which is to basically reduce your expenses. Other than that, I talked about having the emergency fund. Before you do anything else, please have the emergency fund in place. Have your life insurance in place, have your medical insurance in place. I would highly suggest that try to find a fee only financial planner who can help up draw a financial plan for you. And they work on fees, so they don't work on commission, so you don't have to be worried out there. And help and take the help of a financial planner who can help draw up a financial plan for you, because on your own you can invest up to a point, but honestly once your financial life gets a little bit more complicated, where you have more goals and you have lesser savings, then you really do need the help of a financial planner. Other than that, the key mantras, to really have a successful financial life is really about investing early, investing regularly, and remaining invested. Remaining invested is really the key to building wealth over the long term. Most investors do not end up making money because they exit in a hurry, but remaining invested is where you will actually be able to grow your money. And I think the focus on 2020, certainly if you've not done it till now, the focus should be on building financial security. I cannot stress on it enough, but it's only your money that can take you through bad times. So I will answer some questions now on the chat window. All right, so there's a question which is please explain some good investment plans. If you ask me what are good investments to make right now, I would say NPS is a good investment. As I mentioned, you could look at various equity funds depending upon what is your financial goals. Of course, if you're looking at fixed return investments, then PPF is a good investment to make as well. So there's a question, wanted to confirm which SIP method right now to start with. I kind of didn't understand that. And can you just clarify a bit more by what do you mean by which SIP method to start with? Okay. How much percentage of take home salary should we invest in the SIP right now? Well, you see, there's no particular one fixed number that you should be investing in the SIP. I mean, it really depends upon what is your financial plan and what are you investing for. So there's no thumb rule to say that you should have so much in the SIP invested, right? So you will need to work on your financial goals. Use a goal planner. I have one on my website, which is www.finsafe, which is FINSAFE.in. And you can, check out the dreams calculator out there, which is going to help you in deciding how much you need to save for your financial goals. There's a question. Can you please let us know if equity can be aggressively used as an investment option? It can, as long as you're aware that equity investments need to be held for the long term, which is 7 to 10 years, and you should not be perturbed by the volatility. Do we need to prefer any bank while opting for the NPS? No, I do not have any particular preference. Please do your homework. If you don't choose any particular bank, then the default is going to be SBI pension fund. I mean, I'm telling in terms of the pension fund manager. Does it make sense to diversify into US equities, or India Nifty index is enough? See, I'll tell you, if you're going to be looking at buying US equities directly, remember that there is going to be an exchange rate risk, which is going to be there as well, right? So you need to think through this very carefully. There are some funds which are available in India which take exposure into foreign shares, and you might just want to look at those as well. Wanted to confirm, okay, I need some more information on the SIP method that you're talking about. I'm a serial equity investor and able to maintain a decent return. However, it seems that gold has emerged as a good investment option. I would like you to tell me if it's better to go in for paper gold rather than physical gold. All right, so certainly paper gold any day better than physical gold, because um, uh, physical gold basically the making charges are like really high, and the overhead charges that you end up paying are going to be about 25 to 30%. So certainly that's not a good option at all. I think if you're looking at investing in gold, then the best way is through the sovereign gold bond scheme, which is open right now. It's a scheme from the government where it's an 8 year scheme, and at the end of 8 years, whatever is the price of gold, that is what you'll get. It is completely tax free. There's an interest of 2.5% every year, which is going to be taxable. Are there any specific children investment plans that you can recommend? I don't recommend children plans from insurance companies because the charges are quite high and the returns are pretty low. I do believe that if you have a long term holding period, then you can look at equity funds, SIP, that will be a better option. How to figure out how much health insurance or life insurance is needed? Well, for health insurance, for life insurance, as I said, you can do the HLV calculator, which is the human life value calculator. It is there on any insurance company website, and you can look it up there. Now, as far as health insurance is concerned, I believe that if you are a family of four, then I think you should have at least 10 lakhs of family floater and at least 5 to 10 lakhs of critical illness cover. Given the current medical expenses and what it costs to really get a large illness treated. Is NPS better or PPF? Well, you can't compare it because NPS is a market linked investment and PPF is a fixed return investment. So, if you are willing to take some risk, I think NPS is certainly a better option over the long term. It will certainly give you a better return. Now, is it always better to repay home loan whenever possible? Yes, I think it's always nice to be able to get debt free as early as you can. And if you can do partial payments towards your home loan, but at the same time maintain the liquidity, in your portfolio, which means to say that you cannot do the part payment at the cost of not having any funds available in the portfolio in case if you have emergency or stuff like that. But yes, it's nice to be debt free as early as possible. In NPS, are we charged expense ratios of mutual funds? The NPS cost is very low. It's 0.001% compared to mutual funds where the expense ratios are much higher, which is 1% and above. The cost over here is very low in NPS. Can you give us an idea as to who should opt for the new tax regime? Um, so as I said, more than the CTC amount, what you need to look at is your deductions. If your deductions in a year are more than 2.5 lakhs, then certainly the old tax regime is going to make a lot more sense than the new tax regime. So I think, if you are at a sub 10 lakh CTC and you're not taking too many deductions, like you don't have the home loan deduction, for example, then you might, want to take then the new tax regime might help you save some tax. But remember that over a longer period of time, your salary is going to grow and you'll most likely be having the home loan as well. So from that perspective, it's better to stick with the old regime. The government has allowed you to shift between the old and the new regime, but it's not a very nice idea to do it. It's very cumbersome at the end of the day. In Sukanya Samriddhi is separately charged in income tax. The proceeds from Sukanya Samriddhi are completely tax free, so they are not taxable at all. Is if buying gold for children's marriage, which instrument which should be used? The given time period is 20 years. That's a difficult one, but I would suggest buy the gold ETF. I think that will be the best option. If you really want to stick to gold, buy the gold ETF. Otherwise, if you're not too hung up on gold, then I would suggest for 20 years buy an equity fund and hold on to that. All right, so someone has a question. Initially, I thought of not to opt for home loan moratorium, but later I actually opted for as I can save some funds for emergencies, especially in current tough times. And when the current situation settles down, I can anytime put the unused extra amount back into the home loan in order to compensate for the extra interest that I will be paying due to the moratorium. See, what you're saying is okay, but the point is that because, see, there's a cost to take the moratorium, right? The bank is not going to lose out on the interest. So at the end of the day, as I said, that if you are taking a moratorium of 3 months on a 30 lakh loan, which is a 15-year loan, the extra interest that you're going to pay is 2.34 lakhs, right? So I don't think that you can use the moratorium as a very expensive way to actually build up your emergency fund. And honestly, I'll tell you, I think Indian families have a lot of gold which is kept for emergency reasons or for uncertainties. And if you were to ask me, that itself can be your emergency fund today. I think taking the moratorium is a very bad idea because you're just paying a lot of extra interest. See, even if you pay back the interest after 1 or 2 months, you're still going to pay more than what you had to pay earlier. What is Atal Pension Yojana and NPS? See, Atal Pension Yojana is a pension scheme basically for the underprivileged. NPS is a retirement scheme from the government, but it's a market linked instrument. It does not give you a fixed return. There are various investment options that you can choose, which will divide your money between debt and equity. Is ELSS a better option than only equity fund? Well, ELSS helps you in tax saving as well. So if your aim is tax saving, then ELSS is a better option. It's ELSS is just another type of an equity fund. All right, I'm aggressively doing part payment towards my home loan as banks charge so much interest, which cannot compare any mode of savings. Yeah, that's a good idea to do. Is it the right time to invest in the equity market? Yes, it is, because the equity markets are at very, very low levels right now. The valuation levels are very low at this point in time. So, certainly, it's a great time to start putting money in. What I would recommend is that do it in tranches, like do it maybe in 4 or 5 tranches, not everything at one shot. All right. So if we don't have any more questions, I'll just wait for another half a minute. I'm happy to answer more questions. If you don't have any more questions, then do look at your financial life very carefully. Please do take this time to look at your financial documents to see if your financial documents are in order. Try to have everything as much as possible in an electronic form. Spend some time on trying to create a financial plan for yourself. As I mentioned, our website is FinSafe, which is FinSafe. You can check it out. We do have a lot of reading resources out there, and you can check out the goals calculator, which will help you figure out how much you need to save for your goals. So start with that, and try to ensure that you are building financial security. I cannot suggest any SIPs, but on my website we have a list of SIPs which are suggested based on quantitative analysis by an external research agency. So the website again is FinSafe, FinSafe.in. Now, can we cancel the moratorium after opting for it? Well, you'll have to check with your bank, but I think you should be able to do it. Again, under equities, which are the best sectors to invest? Well, I would suggest going for equity funds. I would not really suggest getting into direct stocks, because you don't really know which is going to be the best performing stock or sector in the time to come. Is there any good alternative to NPS rather than people investing in it because it has a tax benefit? Well, I mean, you can invest in it. See, I don't recommend investments in any case for a tax benefit, but what happens with NPS is that it's a good investment. It's locked until the age of 60. So when you're looking at building long-term financial security, it's a good instrument for that. Other than that, of course, you can look at investing in the various equity funds that exist. So I would not suggest buying specific sectors, because again, there are specific sectors which could be looking good right now, because obviously because of what we're seeing right now in terms of the situation where certain sectors are looking good. But I don't know on a long period of time how they look. And generally, sector specific calls can turn out to be very risky. So always remember that if there are particular sectors which are expected to do well, those sectors will be there in all the multi cap funds in any way. So you might as well look at buying a multi cap or a mid cap fund. Which NPS falls under? Yeah, so NPS falls under 80CCD. There's 80CCD 1, which is towards individual contribution to NPS, and you have 80CCD 2, which is corporate contribution to NPS. So your company might be offering you NPS that will come under 80CCD 2, and this is over and above the section 80C. All right, if there are no more questions, then I shall end the video, and please feel free to write into us on our page if you have any questions. We're always happy to answer queries. Thank you so much. Have a good day.